Now, you remember when we were doing IAS 16 that I mentioned that non-current assets can be carried in two ways. One, non-current assets can be used for business purposes. In other words, when we are using the non-current asset for business purposes, it means we use that non-current assets either in the production of goods and services or for office purposes. So for business purposes. Another way we could carry non-current assets is either for rental or capital appreciation purposes. So these are the two ways a company can carry its non-current assets. Now when we're talking about non-current assets here, definitely we are talking about the tangibles, even though some intangible can fall under this thing. But we are holding it for rental purposes, for capital appreciation, or for business purposes. If the non-current asset is for business purposes, then we are going to account for it according to IAS 16, property, plant and equipment, and IAS 36, any impairment on the assets we put it on it, as well as the issue in relation to any capital allowance or deferred tax issue. We're going to carry it, but for tax business purposes, we're going to apply to this. But if we are holding the non-current asset for rental purposes or capital appreciation, that is where our junior brother comes in, IAS 40, investment property. So for instance, if you have an office building and you are not using the office building for the day-to-day running of your company, but you are renting it out to people, then you have to carry that office building as what? An investment property according to IAS 40. If you have bought a land and you are not doing anything on the land, you have not built factory on the land for business purposes, and you are just holding the land, that means you may be holding the land for what? Capital purposes. You have to carry the land according to IAS 40. Now, when we are carrying the assets according to IAS 40, among other things, at the end of the day, they have to be carried at their fair value. They have to be carried at their fair value. So, when it comes to investment properties, what happens is that since we are not doing business purposes, we are not going to what? Depreciate it. But always, it has to be carried at its fair value. What it means is that at least once every year, we need to test for what? Impairment. To see if the investment property has lost value or has appreciated value. When we test for the impairment and the asset suffers impairment, we write it off the way it has to be written off by debiting the income statement with that impairment loss and credit that investment property IP with that impairment loss. But when we test for impairment and we realize that there is actually an appreciation in the value of the asset, then the opposite will be done. We're going to be debiting the, so in that case we debit the IP investment property, and then we're going to be crediting revaluation surplus with that. So we don't depreciate this, we test for impairment. If the value falls, it's impairment loss. If the value increases, it's revaluation surplus. But this is the big question. Sometimes an asset can be used for business purposes, then all of a sudden the company can change it to a rental purpose. Other times, an asset can be used for a rental purpose, then it will be changed for a business purpose. When this change happens, how do we account for it? Simple. As always, if for instance, we are using an asset for business purpose, and during the year we change the asset into a rental purpose, what it means is that we will have to change from IAS 16 to IAS 40. So we were using it for business purposes, but now we are carrying it at investment property. What do? We calculate the carrying value as at the date of the change. We calculate the carrying value as at the date of the change and compare it against the fair value at that date. Because remember what I said here, all investment properties should be carried at what? Fair value. So we calculate the carrying value of the asset at the date of the change, compare it with the fair value at that date. Two things are likely to happen when you do this thing. One, you may see an upward valuation, meaning the carrying value being greater than what? Sorry, being less than the fair value. In this case, this difference is going to create what we call what? A revaluation surplus or revaluation gain. And this revaluation gain will go into the other comprehensive income in the income statement and other what? Comprehensive income. This gain. The second thing that can happen is your carrying value is greater than the fair value. If the carrying value at the date that the change was made is greater than the fair value at that date as an investment property, then you know it, that is going to lead us to impairment loss. And if it's an impairment loss, the same idea is going to run through our head. We're going to be debiting the income statement because that is an expenses, and we're going to be crediting that property with that figure. Any question so far? Now, the reverse is true. What is the reverse? The reverse is changing from an investment property to where? A business purpose. So remember, when you are using it for the business purpose, you are calculating depreciation. So if you are calculating depreciation, that is why we calculate the carrying value and compare it against the fair value. Now, if the opposite happens, so change from IAS 40 to IAS 16. If we are using an asset as a capital appreciation, then all of a sudden the business want to use the asset by themselves. So they sack everybody in the building, give them their money, and they start using the building for themselves. This change, what do? Simple. When an investment property is changed into an IAS 16, it must be carried at the fair value. Because that is what we stated here. Investment properties are always carried at fair value. So whatever value it is there, we just carry it and take it under IAS 16. Then from that date, we begin to depreciate the asset. After the date of change. Remember, I didn't state that here. When you change from IAS 16 to IAS 40, you cease depreciation. So when you do this transition, no depreciation will be charged any longer. We're not going to charge any depreciation. That's very important because it is now an investment property. But when you change from 40 to 16, you will begin to charge depreciation on the fair value of the asset after the date of the change. This is what you have to understand about investment property. So let's look at an illustration about that. and see what we have there. So Men's PLC bought an asset on 1st April 2017 at a cost of 2.5 million with an estimated useful life of 12 years for business use. On 1st March 2018, the company decided to stop using the assets and rent it out for income due to economic downturn. The city was not doing well. At that date, the fair value of the property was estimated at 1.5 million. As at the year ended 31st December 2018, the asset was revalued at what? 1.2 million. Required. How should Men's PLC account for this transaction in the financial statement for the year ended 31st December 2018? Now, what do we see here? An asset bought for a business purpose to be treated according to IAS 16 has now been derecognized and being treated as what? An investment property, IAS 40. So what do? We said that we need to calculate the carrying value of the asset as at the date the decision was made. So we have to calculate the carrying value of the asset as at 1st March 2018. So that will be equal to the cost of the asset. Now we will tell the examiner that all figures are in thousand, so that we can work with 2,500. Am I right with 2,500? 2.5 million, right? Now, when was the asset bought? 1st April. So from 1st April 2017 to now, this is 1st March. Until ending when? 28th February 2018. Is that true? So how many months do we have there? April, May, June, July, August, September, October, November, December, January, February. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 months. Good. What is the years for the assets? How many months are in 12 years? Don't worry. So we're going to have 2,500 divided by 12 years times 11 over 12, right? And now don't worry, we can stay with that. I thought it was more than 12. If it was more than 12, they would have converted these years into months so that we will multiply it by the months. But since it's less than 12, we can do 11 over 12. Now, please note that this is years, and this is months, so don't confuse yourself. So 2,500 minus, what's the depreciation for the 11th month? 11 months. What do you have? Okay, final answer. Give me. So let's see what we have there. One. Now, speak. How do we treat this depreciation? What's the double entry for depreciation? Huh? You debit income statement and what? Credit accumulated depreciation or property, plant and equipment. But be careful here, and I emphasize, be careful. Why should you be careful? Because we are preparing financial statement for the year ended 31st December 2018. I will come back to this thing. I just gave you a gist about it. Now, so this is the carrying value at the date that the decision was made. What is the fair value of the assets? So fair value for the investment property, 1,500. So what do you think is happening here? as at the date the movement occurred, what has happened? Is the carrying value more than the fair value, or the fair value more than the carrying value? So if the carrying value is more than the fair value, the difference will be treated as what? As what? Impairment. So impairment loss at the date of the disposal, of the change is 2309 minus 1005. What we've got? 809. What is the double entry for this impairment loss? Double entry. Debit income statement. You credit the property, plant and equipment, or the investment property. Now you will be carrying the investment property at this value, isn't it? Now, when you do the change, what did we say? After the change, you don't depreciate any longer. That was what I wrote here. Because now it is an investment property. So if we don't depreciate from 1st March 2018 up until the year ended 31st December 2018, what happened? There was another revalued as at the end of the year. So as at the date, it was 1,500. But as at the year ended, it has been changed to what? 1,200. What do you see here? And what? Another loss, right? So another impairment loss. I don't know what kind of asset is this one. Another impairment loss between 1st March to 31st Dec 2018. Are you getting the picture? And that is 15 minus 12. And what do we have? 300. Now, it did not say account. It says how should it be accounted for in the financial statement for the year ended. So look at it. 1. We're going to prepare income statement extract as at for the year ended 31st Dec 2018. What do you think will come in the income statement? Huh? The losses. So the impairment loss. How much? 809 here and then 300 there. Total of 1109. What else will come in the income statement? That's all. What's depreciation? The 191 will come there. That's a lie. Because this 191 this 191 is from April to what? February. But if we are the year ended 31st December, then it starts from January to December. But this thing, it's only from January to what? February. So 2 months. Hence, the depreciation that will come here will be only the 2 months depreciation. So if this thing is for 11 months, then 2 months depreciation will be what? So 191 over 11 times 2. Sounds good? Sounds good? 191 divided by 11, because this 191 is for 11 months, isn't it? So when we divide it by 11, we get for each month. Then we multiply it by 2, because January and February is 2 months. So Jane and Feb, 2018. What do we have? You can as well do 2,500 divided by 12 times 2 over 12. It should give you the same answer. 2,500 over 12 times 2 over 12. It should give you the same answer because it's the same thing. You are taking only 2 months of the entire figure. Do you get the same answer? So that's it. So that is the income statement. Then we go to the statement of financial position as at 31st Dec 2018. What will come in the statement of financial position? The investment property. So under non-current assets, we are going to bring the investment property. And the value at the end of the year, 1,200. This is the answer to the question. So you note that when the change occurred, we did not charge depreciation again, but we tested for what? Impairment. By virtue of the revaluation at the year end, and then the value when the change actually took place. This is what you have to understand under investment property. Any question? So as I said, this may be just a footnote in income statement preparation, just a footnote, or even cash flow. Consolidation, just a footnote. And you are supposed to do this work instead. So you must know how to do the movements and then. So if you have any questions, you put it in the comments box, and I'm going to read your comments and I'll reply to you. So I'll see you in another class.